Hi everyone, my name is Vandita and thank you for joining me on my channel today. Today the topic that we will be discussing would be on PEG. PEG is price to earnings to growth ratio. The question has been asked by Kumar. He wants to understand, is it the only parameter that one should look at while gauging the company's performance, or there are other things that we can look at as well? Well, absolutely, Kumar. This is not the only parameter, but it is one of an important parameter. Okay, let me put it that way. See, there are two ways to look at company's performance. One is the technical way, one is a fundamental way, right? So when you look at the technical analysts, how they work is they look at the trends, they look at the charts, they look at the patterns, they study the past performance of that company, the stock price movement of that company, how it has behaved in the past, and they come out with various patterns. That's how technical analysis works. But when you really want to do a quality study, you can't miss on the fundamental analysis part. Fundamental analysis talks about lot of ratios that are involved when you look at company's performance, right? It is about buying a company. So you just can't leave it like that. You have to look at all the important parameters. You need to look at the market cap of the company, because that shows how is it growing over years. And if the first year the market cap was X, then if it is not 10x after 10 years, then is it worth to invest in that company? Lot of things, you need to look at the revenue per share, you need to look at the EPS, you need to look at the cash flow, you need to look at the discounted cash flow, you need to look at also the free cash flow, P ratio, EPS, PEG, the question that you've asked. When you look at the fundamental analysis. Now today we'll focus mostly on PEG, because that's the topic that we are going to take up today. Before understanding price to earnings to growth ratio, it's important to understand earnings per share, share price of a company, net present value, and of course the PE ratio, which is price to earnings. Now, how is PE calculated? PE is calculated by taking the share price of the company, you divide it by earnings per share. Now, what is earnings per share? In any, when you read the company's performance, you see EPS is, it's mentioned over there. So, when you say EPS of a company is 18 rupees for that particular year, what it basically means is that the company has earned 18 rupees for every share, right? So, it shows the growth of the company, right? So, when you look at the P, which is the share price, the net present value, or the share price, the market cap of the company, you divide it by EPS, you come with a P, which is, for example, for a company, the PE is 30. What it means is, whatever the company has earned in 1 year or over 1 year, as an investor, I am paying 30 times more. If I'm buying that stock, I am willing to pay 30 times more price for that particular stock. This is what P basically means, right? Now, the only question is, as an investor, I would want to know is, it's okay, P could be higher, lower. They say lower the PE, it's better, because earnings per share, as it increases, the PE decreases, right? So definitely lower the PE, it gets better for an investor. But is it overvalued? Is it undervalued? Is it fairly valued? That is an important question that should come to your mind. And that is when PEG plays an important role, which is price to earnings to growth ratio of a company. Now, PEG basically determines the valuation of that particular stock. How do you calculate PEG? You take the price to earnings ratio and you divide it by the growth rate of the company. Growth rate is nothing but it's the profit growth of that company. Now, it's very important. See, you look at the past performance and you come with a particular prediction, or you say that, it is a good stock, it will perform good, but you're still doing speculations here. Only when you look at the future valuations and then you come to present value, that plays an important role. And here the growth rate, when you look at, if you look at any company's growth rate, say the growth rate of a company in first year was 70%, third year was 20%, fifth year was 30%. So first, third, fifth year, which year to be taken into account? Mostly third and fifth year we take, 3 years how the company has performed, and the 5-year growth pattern, no? That's how we look at. So if the 3-year pattern, say we are considering that, so we look at the growth rate in 3 years. If it is 20% or it is whatever the percentage is, you take that and you divide the PE ratio by that and you come up with a value. Mostly it is said that lesser the peg, 1, if the peg value is less than 1 or 1, then the stock is fairly valued or undervalued. But if it is over 1.5 or 2, then it is overvalued and you should wait for the price dip. That's what basically is concluded. But it's important that not many times the growth rate is mentioned in the paper. So you need to calculate that. You can always do that by looking at the profit, right? The profit statement of that particular company. You go to annual report, you look at the net profit the company has made over years. So you can see the current profit growth that they have done and the previous year profit growth, right? So you can subtract the two and divide it with the previous growth, and that's how you can come to a growth rate. And then you calculate it, then you divide it by PE and you come to a peg ratio. It should be, ideally should be 1 or less than 1, and if it is that, then it is fairly valued or undervalued and it's a good time to buy a stock. That's how the peg thing works. You mostly take 3 to 5 years, but you need to understand again one thing. This peg ratio mostly works for only companies where the earnings are stable. So you look at the consumer durables, you look at the FMCG part, the IT companies, sometimes the earnings are stable over there. So only then this is considered. What about other cases or other scenarios? And you cannot completely rely on EPS thing here, right? Because this quite possible, it is possible that the sales happen, the revenue part the revenue part what they're showing, but it's not shown in the cash statement. So the cash flow, the price to cash flow also plays an important role, is an important parameter. Apart from peg ratio, you should look at price to cash flow percentage as well, because that also plays, not percentage, but that value plays an important role, because that shows whether the company has received the cash or it is just talking, So, and in that also, I tell to a lot of people that in cash flow also, you must look at companies' free cash flow, because that's what shows the operating revenue when you subtract it with various expenditures. So free cash flow is, say, if I have a company, I have given all the expenditures, taxes, amortization, all the values are extracted, and then whatever free cash flow is left for me, I am going to utilize it somewhere in the dividend, buyback, or other things, operating expenses of the company. So how I will invest? So that free cash flow plays an important role, and that's how you do discounted cash flow. So that determines the intrinsic value of a stock. That we'll take up as a separate topic, because there's a lot of elements in that. There's something known as compounding and something known as discounted. When you say compounding, it is basically looking at the past, like the past value, and then you make predictions, right? But when you say discounted, you look at the future valuations and you come to the present valuation. And I really like that methodology more, because that gives you the intrinsic value of the stock. But for that, you need immense amount of knowledge. You need a lot of you need to understand that business well. Only then you can look at the intrinsic value of a stock. You just can't come out with anything just by speculating things. So more or less, that is why I say investments with mutual funds are right, because the fund manager here looks at all the aspects that I'm talking about. And when, see, everyone doesn't have that kind of time. So why not to just trust a fund manager, give them a certain amount of, expense charges that obviously we know that the expense ratio that is charged when we are talking about mutual funds. But we have a person who's doing that for you, right? Just select a good mutual fund and invest. If you are not very well versed with the market, but in case you are doing your own study, that's a great thing. But please don't just buy any stock without looking at all the parameters. Like I said, peg ratio is an important parameter. Looking at the cash flow is an important parameter. Looking at the price, because see, if you don't know the net present value, how is it calculated? You will never understand if it is a good stock or not. Net present value, you see lot of years. See, if current year it's 1 lakh, next year it's 5, third year it's 10, next year it is 5 lakhs more. So net present value, how you get it is you add up everything and you get an average. So there are various ways, because that tells you whether that stock is worth buying or not. There are a lot of things. I mean, when I talk about cash flows, net present value, there are a lot of aspects in it. I'll take it as a separate topic where I'll explain you everything. But I hope peg ratio was clear. Coming back to the topic, it tells you whether the stock is overvalued, fairly valued, undervalued. If the peg is 1 or below 1, it is a good thing to go for it. But it is not the only thing that you should look at, because it doesn't mean sometimes if the peg is high or PE is high, doesn't mean that the stock is not good. There could be certain other expenses that the company is doing. So maybe the company has good vision, but look at all the possible aspects. It's a big thing. It's a big world. So you just can't, stick to one thing and move on. You need to look at a lot of parameters when you talk about selecting a stock, right? So all the very best with your investments. I really hope you have understood what I'm trying to say. And on that note, thank you very much.